Hello and welcome to our latest Insider interview. Today in the studio I have with me Tristan Purcell, who is co-fund manager of the Fidelity Global Dividend Fund. Tristan, thanks for your time today.
Thank you for having me.
So Tristan, I wanted to firstly start off with performance. So in regards to 5-year performance, the fund has underperformed the MSCI All Country World Index. So why has the fund underperformed over that time period?
We have underperformed over 5 years. The main driving factor for that is the leadership in the market has been in these larger US tech companies that typically don't pay significant dividend yields, and therefore we don't really consider them part of our universe. But over the longer term, since the fund's inception 13 years ago, we have delivered a 12% annual return, which is extremely close to what the broader market has delivered. And we've done that with significantly lower volatility and lower drawdowns. I don't want to give a completely politician's answer, so I dig particularly into that 5-year point. If you think what happened 5 years ago, this was a period where in September, October 2020, everyone was locked at home. And because of COVID, lots of people were picking up day trading for the first time. You had Wall Street bets became very popular. And that's not a type of market where we typically expect to outperform. We don't own those highly speculative types of companies like GameStop that performed very well in that period.
And over the past 5 years, and indeed over longer term timeframes, particularly 10 years, it has been a pretty smart move for investors to just own the global stock market through an index fund or an ETF. Do you think going forward in the coming years that will continue to be a smart decision by investors?
They've certainly been right to own index funds, or it's been served them very well for a long period of time now. But I guess if you look back through history, whilst it's been good for 15 years, and that sounds like a long period of time, it wouldn't have always worked. And as this trend extends, it introduces more and more risk into those products as they get more and more concentrated. So what I mean by that is if you imagine a portfolio of just 2 companies, both with the same weights in each, one company's share price stays completely flat and the other one doubles and then doubles the next year and then doubles the next year. You can imagine that that portfolio over time looks more and more like that one company that's doubling, both in terms of performance and the risk characteristics and so on. And that's great for as long as the company keeps doubling. But obviously it can't go on forever, because ultimately if that happened in the global market and one company kept going, the whole global market would be in one company. Then obviously when it unwinds or that one company doesn't work, you have a period where the long tail of other companies in the market actually outperform that small handful of companies, and you get an environment like you saw in the unwind of the tech bubble in 2000. So from 2000 to 2010, the cap-weighted index, or what you typically get from an ETF or passive product, only delivered a 10% return. So over that decade, you only made 10%, not per year, but in total. Whereas if you look at the equal weighted index, which is exactly the same companies, but weighted completely equally, same weight for every company, and then it's regularly rebalanced to reset it back to an equal weight, that index, the equal weight index, more than doubled over exactly the same time frame. So history suggests, and there are sort of first principles thinking, that it can't go on forever, but I've no idea when it might end. It reminds me of something Russell Napier said, which was, if you see something in markets that seems excessive and you think can't continue, however long you think it can go on, double it and then subtract a month.
The fund invests very differently from the index. You have a high active share. In terms of what you don't own, 2 things that stand out for me is that you are underweight the US, and you also don't own any of the Magnificent 7 technology stocks. Could you explain why?
The US market has now become over 2/3 of the global market. And within the US, over half the market now is the Magnificent 7 and the rest of the tech sector. And that's up from 20% a decade ago. So it's become increasingly concentrated. And that is not a natural picking pool for us. Obviously in the US in general, yields are lower, but within the Magnificent 7 in particular, none of them yield over 1%. I think the highest is Microsoft, which is 70 basis points or 0.7%. And we really like everything we own to be contributing to our return profile, both in terms of the dividends we're paying to our end investors and the capital growth of the portfolio. Because, the product has dividend in the title, we expect our end investors to get what it says on the tin. Even if these companies were paying reasonable dividends, things like Tesla, for example, is not naturally the type of company we'd like. Its future profits and its current value today are all tied to things that are way out in the future, like robo-taxis or humanoid robots. And those things have a huge range of outcomes. And when you combine that huge range with the fact that it's a long way away, and you discount it back to today, that means today's share price, you can come up with a huge range of potential fair values. And we don't like owning companies where there is a lot of potential downside.
And in terms of the companies and sectors that you do have exposure to, how would you say the fund is different from the global stock market?
I'd say there are three key features that are different to the global market. The valuation is lower, the yield is higher, and it's significantly more defensive. So if I put some metrics on those, the the PE multiple of the fund is around 15 times today, compared to the broader market at around 22 times. The yield is just over 2.5% compared to the broader market at 1.7%. And really, we sort of seek to create a diversified portfolio across a range of countries, a range of sectors, a range of different business models. Because ultimately, no matter how well you research a company or analyze an industry, something can always come out of left field and hit you. We don't like to have all our eggs in one basket. So you can create that defensiveness by having large top-down allocations to classically defensive sectors like staples or like utilities, like pharmaceuticals. But again, the trouble with that is, an example this year, pharmaceuticals got hit by RFK and tariffs in the US. So even when you think you own a defensive sector, you can still get hit.
In terms of your country allocation, at the moment, the fund is 10% overweight to the UK. Could you explain that stance and provide some stock examples?
So none of our country allocation is down to a top-down view on the economy, whether that's the UK or the US, or that market, the US or the UK. Everything is selected on its own merit. Today we have 4 UK companies in the portfolio. I can run through them quickly. They are Tesco, Unilever, National Grid, and Admiral. So Tesco, I'm sure a lot of people listening and watching will be familiar with. They obviously grew a lot, expanded into lots of different products and regions, and became quite a complex beast. And then a decade ago, that all unwound. Since then, they've become a lot simpler. They're now in the process of selling the bank, or have just finished selling the bank. They have made the pricing more competitive to become more in line with the discounters, and they've actually started gaining market share again. So the yield there is 3.5%. Then you get the same again in a buyback. So you don't really need to grow much on top of that to get a decent return. Unilever, again, has been quite a complex beast that's diversified into lots of things. They're now in the process of simplifying. They're about to spin off the ice cream business, Magnum Ice Creams, which I'm sure people are familiar with. Again, there, the yield is just under 4%. Then National Grid, I think, is more broad in that demand in general is rising, particularly in the US, which is half of National Grid's business, thanks to EVs and data centers for AI and so on. Yield there is 4.5%. And then the last one, Admiral, company we've owned for a very long time, I think nearly 10 years now. So UK car insurer that's steadily taken share through better data analytics, better claims handling, and ultimately being the low-cost provider in a reasonably commoditized industry. And the yield there is around 4%.
And when you're assessing the overall health of the dividend-paying market, what would you say is the biggest risk that could derail the fortunes of dividend-paying companies?
Yes, so I think most companies that run into trouble because of their high payout ratios or high yields are those where they pay out too much of their free cash flow as a dividend and don't leave enough left over to service debt repayments or pension obligations or any litigation that might come along, or reinvesting in the business, whether that's working capital, inventory, paying your suppliers, whether that's building new factories, doing R&D to develop products, things like that. So if you have a period where all of those demands on the rest of the free cash flow start rising, particularly if you combine it with a period where sales and demand is falling, you can have a pretty dangerous mix. There's no one sector in aggregate that I'd call out, but you can definitely point to certain handfuls of companies. So in beverages, for example, these historically have been extremely stable businesses. So they were able to raise a lot of debt, lever up the balance sheet quite a lot. They could pay out a large proportion of their earnings because it was predictable. But ultimately now, people just aren't drinking alcohol as much. So they are potentially a bit stretched. And then within industrials, unless you sell a product that goes into a data center or an aircraft, over the last 3 years, you've really had a pretty weak demand environment. So if you went into that with structurally low margins or a levered balance sheet and so on, eventually it could all run into trouble.
And finally, Tristan, a question that we ask all fund managers that we interview: do you have skin in the game?
Yes, I do. I invest in the funds. And actually, when I left the Air Force to join this industry, my ultimate target was to eventually be working on a product that was diversified and I'd want to invest my own money in. So I'm very happy to now be doing that.
Tristan, thanks for your time today.
Thank you for having me.
So that's it for our latest Insider interview. Hope you've enjoyed it. You can let us know what you think. You can comment. And for more videos in the series, do hit the subscribe button and also the like button. And hopefully I'll see you again next time.